You say the worst is behind us on inflation, but there looms another risk. It is a big one. It is called recession. When, how pronounced and deep, and what will the effect be on stocks?
Yeah, good afternoon, Tyler. Good to be here. So yeah, we believe that the worst of inflation is in fact behind us. But as far as the recession or the looming recession to come, as we look across the broad preponderance of economic data, to us, it seems like recession is a high probability, sometime likely in 2023 at this point. The reality is that this is likely to be a Fed-induced recession, meaning that it's probably going to be more garden variety business cycle type of recession, as opposed to something that is, put forth by a crisis that oftentimes makes those recessions more difficult and deeper to endure. So we would anticipate that it should be fairly mild, fairly typical, but nevertheless, stocks have not priced that in and will likely be pricing that in the coming weeks and months.
And we're starting to hear some warnings. We're starting to hear about companies planning to slacken their hiring pace and so forth. What stocks will be the ones that will be most vulnerable if we move toward a recession and the stock market starts really to discount one?
Right. Great question. So I think, first of all, you got to avoid the cyclical areas of the market, those that are most sensitive to the business cycle. If we are to see a macroeconomic recession, those types of sectors and industries are going to have the most revisions to their profits downward. So I think those stocks are probably going to be most impacted. But there are areas that you can, I think, build a portfolio around, even with the recession call. It's not about going all in or all out or going to cash or making these wholesale moves. Rather, it's about tilting the portfolio to be defensive while retaining that long-term fully invested tilt. So we like large cap tech still. We think that's likely to perform on a relative basis through recession better than some cyclical areas of the market. Stay away from high valuation, no profit tech, which has been killed this year, but should continue to do poorly during recession. But also add to that some low volatility as a factor. Having LVHD as our preferred ETF in low volatility right now, kind of given the intersection of that factor, i.e. low volatility with high dividends. We think given the macro, a recession coming, but still elevated inflation, and a Fed, as we saw at Jackson Hole today, that's still pressing on the accelerator, having dividends is important.
What kind of stocks are in LVHD, the ETF you just mentioned? What kinds?
Great question. Great question. So the sector weighting is utilities, it's consumer staples, and it's real estate. It's heavy, those three sectors. And you're going to see things like Johnson & Johnson, Pepsi, Dominion Energy, et cetera, et cetera.
Gotcha.
What are your thoughts on commodity-focused stocks and ETFs? Certainly energy, the best performing sector so far this year, Jason, but now we're seeing oil trade lower on these growth concerns. Gold on track for its worst week in a number of months.
Yeah, so commodities are very sensitive to the economic cycle, as you noted. We are seeing, I think, to some degree, some softness on the demand side as a result of the slowing macro. The Fed is making that situation worse by continuing to press the accelerator on monetary policy, raising rates. So I think those are going to be sectors that are going to be very difficult to own, whether it's energy, whether it's materials, whether it's commodities producers. They're going to see very large revisions to their profitability in the coming quarters. And I think the stock market's going to reflect that in the share prices, unfortunately, very painfully for those who are in those sectors.
Did we mention that among the defensive names you like are defense stocks?
Right. Yeah, Lockheed Martin is our favorite pick there. And not only do we like the business on rising global defense budgets going up in response to the brutal war in Ukraine, but the reality is that it also not only does it have a defense business, but it's a defensive stock in that its beta is quite low. And again, that's the goal here in tilting the portfolio, is to take beta out to smooth the ride, but staying fully invested. Lockheed Martin has a beta of about 0.25 if you look at it on a 3- and 5-year basis. You can see today that it's performing on a much better on a relative basis versus the S&P and, of course, tech.
Simply put, for people who might be newcomers or not familiar, a beta of 0.25 means that that stock will move
relative volatility
relative to the market at 1/4 the pace, 25% of market volatility. Got that right?
That's correct.
I got it right on the SAT. That's great. All right. Thanks, Jason.
You did.
Yeah. Have a great weekend.
Thank you.
Man. Bye.
Appreciate it, guys.